We did a little study. This is our, I think, fourth iteration of the study that we did this summer. These were the goals. And what we found principally in updating from 2001 to 2003 is that we found more partnerships and fewer people going it alone. And we found a larger amount of initial capital being raised. The return analysis has not changed dramatically overall, but what we have found, as you'll see from the next slide, is that many funds did very badly. They either lost all the money or they had negative returns or minimal returns. But as you look at this, 42% of the funds had positive returns, but if you just look right of center, you notice that there's still some positive returns that would be disappointing both to entrepreneurs and to investors. So part of what we'll focus on tonight, although not all of it, is lessons learned, and try to understand how we can do better, or search funders can do better in their quest to have their own business that is profitable and produces a happy outcome both for them and their investors. You can see that the overall returns didn't vary substantially when we updated the study, but that's a little misleading in the sense that the companies that were doing great already just continued to roar, and those returns helped a lot to cover over the losses and disappointing returns from many of the funds. So I think one of the bottom lines here is that this is a risky undertaking. And I think all panelists would say that none of us is proselytizing any of you to undertake a search fund at least without your eyes wide open. We're just trying to sort of demystify the process and help to understand the risks and potential rewards. And you can get further information digging behind this from Mary Burnham or Linda Wells in the center.
I've been asked to talk a little bit about the decision to raise a search fund, to touch on the decision of whether or not to do it with a partner, to discuss fundraising and strategies therein, and then to talk a little bit about the search itself. But try and get a real accurate depiction of what the search fund has been like for John and I, and that's a little more difficult than it sounds simply because I'm torn on the topic. Irv is right. It is not without risk, and it's not without heartache. If I look at it from a high level, it's been a fantastic process. I can't imagine doing anything else for the last couple of years. But at the same time, it is fraught with lots of little perilous things that you have to do. So I'll try and give an accurate view of that. So in deciding to raise a fund, both John and I wanted to do something entrepreneurial when we came to Stanford. The VC tech model didn't appeal to us all that well. We started looking at some lower tech businesses while we were here. And then in the spring, we took the seminar with Professor Grossbeck, and many of you might not know this, but he's a bit of a tease. He did a class that was filled with case studies on search funds, and we got so excited about it. We loved what we saw. We loved the idea of running a company together. So we both actually independently approached him in 2000 and said, hey, this is a great model. Sign me up. How do I do it? And he said to us, don't even think about it. Don't even try it. And it was pretty accurate and good counsel, not surprising. It was just values were way too high at that time. The tech boom was just cooling off, and valuations even for small private companies were still excessively high. So we went our separate ways, but back in about 2001, John circled back up with Irv and got advice of a different nature, which is that it's now becoming a more attractive time to do it. Valuations were down a little bit. So we decided to take the plunge. And as we sat down and thought about it, there's a whole list of pros and cons to doing the search fund. It's something each of you would have to ask yourself. As we thought about it, for me personally, it was a chance to work with a close friend and someone I respected immensely, to work with a good friend, John. We both wanted to run a company together. We talked about it in business school, but when we really step back and think about it, no one in their right mind was going to hire us at this point to run a business. And so we figured we had to go out there and make an effort to purchase one on our own. It gave us the ability to handpick a group of mentors that would be our investors. It allowed us to mitigate startup risk, mitigate operating risk by buying a stable, profitable company, and then also mitigate our own personal risk. And then on the flip side of that, it also limits your financial upside a little bit. You don't get the same amount as you would if you were starting a startup from its inception. And you also live with a lot of risk and a tremendous amount of ambiguity. And that's not something that we had anticipated in the beginning. There's a lot of the process that's just outside of your controls, whether you're dealing with sellers or whatever it might be. It's a difficult time. So for me, I came home one day after talking it over with my wife a lot and pretty much came home and said, honey, great news. I'm quitting my job. John and I are going to go out there and raise a search fund. And by the way, we're not going to pay ourselves anything while we're doing the search fund. That'll be about 6 months. And then we're going to conduct this search. That'll probably be a couple years. And during that time, we'll pay ourselves just a small raise off of paying ourselves nothing. And then if you stick with it, though, the good news is we'll move to some random place in the middle of nowhere and go run our company. And that is a recipe for true excitement from your spouse. But she stuck with it. Liz, John's wife, stuck with it, and we're incredibly supportive. That's the biggest piece of advice I'd give in considering to do the search fund is to think about how it impacts your significant other, because it will impact them, and you need to talk about it. In deciding to partner, as I mentioned, it wasn't much of a choice for me, largely because John approached me about the idea when he spoke with Irv, and so I didn't have much of a choice. If I did have a choice, I'd probably be working with someone else. Actually, one thing I can say sincerely about this is that if I wasn't doing this with John, I would not be doing it at all. The partnership was a very important element for me. It was a critical part of my decision-making, and I think there's huge value in deciding to partner, and I think that's probably behind some of our statistics. A lot of it is that it's a lonely road when you're out there searching. It can be very difficult, but there's also other huge advantages. Yeah, we agree. There's also huge advantages. You can divide and conquer. There's any number of things we could talk about in the Q&A. But what I would say is that you need to be careful, because when I talk about the partnership, I'm always careful to note that I'm a fan because of my specific partnership. I wouldn't jump into it blindly. You absolutely have to be honest with yourself. And if you're going into business, someone recognize that you guys are going to be going through a lot of heartache together, a lot of good times, but just be honest with yourself. And what we did is start out with a real touchy-feely session, talk about our goals, talk about our commitments to each other's professional careers, talked about even things as tactical as how we were going to decide when we had a conflict of interest down the road. I think it's really important to do. In deciding to raise the fund, you saw from the statistics, funds are getting a little bit larger. I think it makes a lot of sense to be sure that you make an accurate budget and raise enough money to support yourself for a couple years. And the truth is, a lot of people look at it. Probably a lot of people in this room would say, hey, this is a nice thing to do. Maybe I don't like what I'm doing right now. I'll just go out and buy a company. And it is a lot harder than it sounds. You drive down the street and you're like, oh, that's probably an interesting business. And I guarantee if you could go in and look at that business's books or understand their customer concentration or understand the strategic risks they face, you just run right out the front door. And that's what we found with almost every business that we saw. You just would never want to touch it. And so you need to buy yourself that runway. And it's one of the beauties of the search fund model is that you do buy yourself that runway. You buy the ability to walk away. Even if you've been working on something for 6 months, if it starts to smell funny, you can walk away. So in thinking about it, raise enough, because the other little dirty secret of the search fund is that getting a deal done, there's an incredible amount of professional fees that you rack up. And so it's probably safe to assume that you might spend as much as $50,000, $100,000 on a deal. And there's not so many of those deals you can do if you raise a modest amount of money. On to fundraising. This is a little bit of an awkward topic for me to talk about because Mr. Peterson here is in the audience, and he was one of many distinguished characters who were invited to join our crew, but declined. And it's not embarrassing for me at all, understand? It's
embarrassing for me.
It's embarrassing for Joel because we're a wild success, as you'll hear about later. Raising the fund is difficult, but it's eminently doable. It can be a hard pitch because you're going in and basically saying, hey, give me some money. I'm going to go out, run around, look for a company to buy, and as a reward for giving me that money, I'm going to come back to you in a couple years and get even more money from you, and we're going to buy the company together. But the truth is, the search fund has a lot of merits. Our pitch when we raised the fund was to point to the historic returns, really to lean on the search fund study, point to the mitigating factors, mitigating startup risk, operational risk. It's true, you don't know the specific company, you don't know the area, but you do know specific criteria you're looking for, and that carries a lot of weight. And I'd say for us, the couple of tactical hints is that perseverance was key. We tried not to hear no from anyone, with the exception of Joel. If we were going to hear no, we tried to defer it for as long as possible and just keep people on the hook, keep them interested. And we also just emphasized that it was a unique invitation. We had the advantage of a equity group being interested in our fund from the beginning. And so we invited them in for part of our fund, and we were able to go to every person afterwards and say, hey, we don't really need the money here. We need your expertise. We need your guidance. We want you as a mentor, so please consider investing. And that was helpful. So if you're raising a fund, just deny a few units right off the bat. That's the best advice. My final minute or two, I'll just talk about the high level of doing the search. Don't glorify the search. I think most search funders say that it's like boot camp. They're maybe happy they've gone through it, but they'd never want to do it again. There's a tremendous amount of ambiguity. Our process took us about 18 months looking at hundreds of companies, making offers on a couple dozen of them, and then ultimately getting down to an LOI stage on a few. The last thing I'll touch on is just the general theories around searching. There's two schools of thought, as far as I can tell. One is sort of more the traditional search fund view, which is you become an expert on an industry and you really drill deep. And that is a fantastic way if you can do it. You become an expert on the industry. You typically can source deals that are unique. They're not actively for sale. You might have a better chance of garnering a better valuation. The problem is it's just a needle in a haystack. It's very hard to find companies that are interesting and that are interested in selling to you. So then that leads to a second school of thought, which I'll call the lazy man's approach, which is looking at companies that are actively for sale. And that's great. You can see a lot of deals, but it's incredibly difficult not being an expert on the industry when you start to look at it. And I think a lot of search funders would say they burnt a lot of their search fund wasting time just looking at deals that were by brokers and so on. So the final comment I'll make on the search is that the strategy we used in the search, which worked pretty well for us, was a hybrid of both. We looked at lots of different deals, and we were always willing to look at deal books and talk to intermediaries and talk to lawyers and accountants, just as a way to keep ourselves sharp and learn about different industries. But once we learned about industries, we really tried to drill down on specific ones, and then we would try to actively source deals that were for sale within that company, either through boutique M&A banks, consultants, river guides, this kind of thing.
Great, thanks. David?
Thanks. So my name's David Kennedy. I was class of 98 here at Stanford. Set up a fund about 2.5 years ago, I guess, and we bought a company at the start of this year, which is so far going well. Irv asked me to touch on 3 different things today in terms of my homework. One was dealing with sellers in the sale process. One is dealing with debt and equity holders or people who can provide debt and equity to you through the purchase process. And the final one was sort of due diligence and dealing with lawyers and accountants and so on and so forth. In terms of those 3, I think the most important one is probably dealing with the sellers. We pretty much, I think, learned 3 different principles of things in terms of dealing with the sellers, which unfortunately can tend to conflict with each other, which is when life starts to get entertaining. The first principle, obviously, in terms of dealing with the sellers is you want to get the best deal possible that you can for yourself. The second thing that I think is undoubtedly true is that the process of purchasing is as much a sale process of yourself to the person who's selling you the business as it is an actual buying process itself. And the third thing that I'd say in terms of a general principle, and I'll go into each one of these in detail, is that particularly when you're dealing with sellers, the key thing that you're looking for as a search funder is to waste as little time as possible on the deals that just generally aren't going to get done. And as I say, all 3 of those are interesting. All 3 of them are good rules to keep in mind. And at the same time, they do tend to conflict sometimes, and I'll explain why as I get into them. On the first one, which is getting the best deal possible, I think that it helps enormously, to Josh's point, if you actually know the industry pretty well. I think that there is that one end of the extreme, which is that you focus just on one particular industry. I have a couple of friends who are HBS class of 98. I normally got a boo when I was at Stanford. That's really bad. And who, in fact, Joel is an investor in, who focused for their entire 2 years of doing the search on one particular industry, which was custom furniture, the Brand Root guys. They saw over 100 sets of P&Ls and balance sheets of folks who were all doing exactly the same thing. By the time they finally closed on the deal that they closed on, they had toured over 20 plants. They'd put together 8 or 9 bids, and they knew the guy's P&L and balance sheet so much better than he did. They were able to look at it and say, your G&A's out of whack, the sales here, you've been underinvesting. It's pretty clear you're not having the best deals you could have with your distributors and so on and so forth. And it makes that whole process of deciding how much you're going to buy for a company and working out the letter of intent stage what the key items are that are up for grabs so much easier for you if you can do that and you can focus on a specific industry. And I would strongly recommend that even if you don't go to quite the extreme they did, which is just the one industry for a couple of years, that at least you have to focus on an industry for a couple of months, and you need to see a number of deals inside of an industry before you can feel really comfortable that you're getting the best deal that you possibly could get. If you don't know much about the industry, or you're looking at the very first deal, you still need to get a pretty good idea of what's a reasonable price to pay, and that is when things start to get a little bit entertaining again. We obviously wanted to get to terms as fast as possible with folks, and what was necessarily unclear to us was whether or not those were terms we were necessarily going to be able to get a deal done on from the point of view of the equity and debt providers. If you don't know the industry very well, then there are a couple of things you can do. You can obviously talk to friends and advisors. We had a bunch of buddies who were working in the world of private equity. We'd ask them approximately what they'd pay. Irv got a couple of calls that were quite frantic at various different times, asking him whether or not we were fundamentally overpaying for the business we bought, and we were, and we did. Other things obviously you need to do is you need to build your financial model, work out exactly what it is you can afford to pay for the business and where the returns are going to come for you. And then the other thing I think you need to do from a price point of view is you need to talk to the opinion shapers among your investors fairly quickly once you've decided that you've got a deal. It's important, I think, to be able to encapsulate very fast in kind of a couple of pages what the deal is, what the company is, how it is you think you're going to be able to create value, what the key risks are, what you're going to do with them over the period of time when you're doing diligence, and get those out at least to a few select members of your investor group quickly so that you can find out whether or not the deal is possible to get done. The second thing is the fact that this is a sale process as much as it is a buying process. I think that's particularly true, actually, if you're dealing with a broker, though it's also true if you're dealing with an entrepreneur. The classic search fund idea is that you find somebody in their 70s who's suffering from prostate cancer or what have you and who wants to move on his deal. And I say that, and the first 3 deals we actually looked at and got to the LOI stage were with 3 guys who were, all of them were in their 70s, all of them, in fact, did have prostate cancer, and all of them were looking to sell their business. We began to feel like we were kind of ambulance chasers who should really be trying to source deals by hanging around in oncology wards at hospitals and so on. It kind of got a bit... But it's true that there's a piece to this which is trying to sell yourself to an older person who's built a business over their life and who feels that it's their baby and who wants to hand it on, who wants to pass the torch over to somebody who can carry that flame over a period of time. And that's something that's very important. It can help somewhat in the price. I think people tend to overestimate the extent to which it helps in the price, frankly. It might be worth $100,000 in a $10 million deal. It's certainly not worth $1 million, and I doubt very much it's worth $500,000. But it's important to get that level of trust with somebody, not least because if they don't feel comfortable that you're the right person to run the business, to look after their employees, to keep the brand name going, then they're highly unlikely to sell to you, and particularly when it hits bumps in the road. And bumps in the road happen in every single deal. Obviously the ones that don't happen, but even the ones that do happen, I haven't heard of one that didn't have a variety of things that glitches in the process. There's a sale process also with the brokers. The non-personal side of things, which is the credibility that you have as a search fund, is close to minimal. You've never bought anything before. You don't really have committed capital. You frankly don't really know what you're doing, particularly at the start, or at least we certainly didn't. And what you're trying to do is do the kind of Wizard of Oz thing of don't look at the guy behind the curtain, look at all the stuff over here, look at our website, and look at these glossy brochures that we have. You try and get your investors to write letters saying that, yes, indeed, the money's there, and they firmly believe you're going to buy something. You put something up on your website or in your materials that talk about the amount of businesses that your investors have bought in the past, as opposed to the businesses that you've bought, and you hope nobody asks the question. There are a variety of things that you can do. Again, I think having an industry focus helps enormously because an introduction that comes from the head of an industry association is worth so much more than a cold call from me on the other end of the phone. You can buy businesses off of cold calls. It does happen. In fact, I think the road rescue deal was actually a cold call of one kind or another. But the vast majority, I think, of industry-sourced deals come through the river guides that Josh was talking about. And that process of selling yourself inside of an industry gives you credibility as you talk to the sellers. Then the third thing, which is wasting as little time as possible, a lot of folks you're going to deal with just want to hear a number. They want to go back to the country club and say, some hotshot out of Stanford Business School just offered me $20 million for my business, and am I cool? And they're not doing this full time, and it's not, for them, time isn't necessarily a critical resource or a scarce resource. What you need to do is, if you're going to do this process, quickly get to the stage with these guys where they start to feel a little bit of pain so that you can shake out the folks that aren't serious and the folks that are serious. And this, again, is where it starts to, this is where it clashes with the fact that it's also a sale process and you're trying to make people feel warm and fuzzy about you. I think you need to get to see a set of financial statements as soon as possible. I think you'd like to see a set of financial statements, frankly, before you'd ever go and visit anybody in person and start getting on planes and flying around the place. I think you want to talk terms with these guys, and particularly the tough terms, the ones that they're not going to be happy to talk about with you, as soon as possible so that you can get things out in the open as fast as you possibly can. I think that was a learning for us. We spent a lot of time in our first 3 to 6 months on a couple of deals which, frankly, in retrospect, we knew full well in week one were probably not going to get done. There were a couple of key issues which we just didn't want to face because we were kind of jazzed about the fact that we had a deal and we were doing a search fund. We were supposed to be buying a company. And we knew if we actually approached these issues, then the deal would all fall apart. And I think that as we got more experienced and better and just more mature about things, we moved and we brought those things out as soon as possible, and we were able to move forward fairly quickly. The last thing that I would say is, in terms of dealing with sellers, I think that there's a great advantage in having a seller who's actually a relatively savvy person. And this, again, is somewhat of a clash in terms of the price that you can pay. You're more likely to get a good deal from a seller who doesn't have a good lawyer and doesn't have a good advisor. On the other hand, it's my firm belief that you're typically not going to get a deal done ultimately with those folks either. And what you trade off in terms of the extra $500,000 you might have saved in a $15 million deal, you lose in terms of the likelihood that the deal is going to fall apart through the process. And I think we got a piece of advice from David Dodson, who's one of the most experienced search funders out there, which was early on, recommend that the guys you're talking with get a good deal lawyer or a good deal advisor. And I think it was invaluable advice in as far as when we didn't follow it, the deals fell apart. When we did follow with the one that we actually closed, they had lawyers and brokers who were helping them through the process, and I thought that it was very valuable stuff. There's also an issue there which is worth just briefly touching on, which is to the extent that you find issues with the company which are going to cause things to come up that are bad news for the seller, you probably want to raise. There are two ways of looking at this. One way of looking at this is you get him to commit. You spend an awful lot of time doing due diligence. You can talk to a series of his clients. You can talk to some of his employees. And then you can ultimately bring it up when he's already half pregnant, if you will, and you are too. And you can hope then to try and renegotiate down the price. We were very uncomfortable with that. We actually were recommended doing it a couple of times by investors of ours. And then there were other investors of ours who told us that that was not the smartest thing in the world to do. I think that that's an ethical choice, but I also think it's a practical choice for you folks. Again, it gets to the stage of, do you want to waste time going down the path with a deal which ultimately you think there's a reasonable chance it's going to fall apart, or do you not? And for us, we always try to tackle that stuff up front, and I think that I'm glad that we did, not least because where we are now, having purchased a company 10 months ago, the sellers are still working with us. We're a 4-person senior management team. We have great relationships with these guys, and it's partly because we were pretty honest, open, and upfront with them throughout the entire process. The rest of the stuff I've got to deal with, I'm going to be substantially shorter.
We only got another 1 minute here to stay on track. So
there we go. So I'll be much quicker on these ones. Debt and equity holders, I think I've already touched on the fact that you need to talk to those guys fairly quickly through the process, particularly your equity holders who are key decision makers. I think the other things to bear in mind, other than getting to talk to them early, are that you need to maintain a lot of control and credibility through that process. And be careful when you do talk to people early on that you're representing a very professional way of looking at the deal. You'll always feel emotionally pretty tied to the deals that you've got. It's very important to show to your investors that you're looking at it with a relatively cold eye, that you know exactly what the reason is to do the deal, that you know what the risks are, and you've got a diligence pack that you're going to put together for them so that they'll feel comfortable about those risks. You only get one chance with most of your investors to convince them on your deal. Or at least, let's put it this way, if you don't convince them the first time, you've probably lost them. And so it's very important that first time, although you're talking to them early, to tell them things that they're going to be comfortable with and to try and sell them on the deal. The final thing that I would just say from the point of view of lawyers, accountants, and diligence, other than the fact that you should have the sellers have one, is that they're definitely a necessary evil. Experience from them is key, particularly in the point of view of lawyers. You want lawyers who have done deals before. You preferably want lawyers who have done search fund deals before. And in particular, there's a couple of law firms out there that have not just done search documents, and so it's cheap to pull them together, but they also understand the cash drain that you have and the limited budget you have, and so they'll carry you through till the end of the deal. And those are the folks at Choate Hall & Stewart who we used, and the folks at Goodwin Procter who a number of other search funders have used. They're both in Boston. They're both wonderful firms. I'd recommend both. And then finally, from the point of view of accountants, again, I would suggest sometimes you're going to need those folks. If you can get an audit that's paid for by the sellers, great. Get an audit that's paid for by the sellers. If you can't, then you'll at least want to spend a fair amount of money doing forensic accounting, looking through the history of what's going on in terms of the books. The remainder of diligence, again, I think comes down to it's deal specific. You want to understand it with your key investors early on, explain to them what it is you're going to do, execute on it, and again, be open and upfront with people through the process, because if you lose trust with your investors, you can pretty much write the search fund off. that's pretty much it.
That's very helpful. Before Brent takes over, I just want to say that most of us in this room would probably be happy to change places with Brent, our next speaker. He's bought a company from a search fund, run the company successfully, sold it, and now he and his wife and 3 children are off for a year in New Zealand. Brent?
Thanks, Irv. The lighter side of that is that I'm one of those people that drug my young wife off to a horrible place. In this case, Fresno. We just won worst air in the nation. Yay. Crowded out Riverside. So it's been 10 years there, paid our dues, and Professor Grossbeck asked me to share a few insights and lessons learned from that experience, and also how the sale process went. Just about every search fund has as a common denominator financial leverage, and we all understand how that can juice your equity return. In the case of a commodity business like ours, which was making paperboard boxes, like a Krispy Kreme donut box, for example, one of our larger customers, the characteristic of operating leverage was hugely important too. And it's simply the fact that a linear growth in sales, once you're past your break-even point, gives rise to a much better than linear growth in profitability. That characteristic really applied to this business, and that was something that we understood going in, and something that we told our investors was going to be a robust source of improvement. We also thought, and we're completely mistaken in this, that improving the manufacturing operation itself was going to be important. We'd taken operations class here at the GSB. We worked our tails off on all of that and optimizing manufacturing processes, and it turns out that really isn't that important in a business like ours, even though that's what we do. And to explain that, $1 of paper box sales is about 50 cents paper. So it's more than 50% of COGS. Our business was a little more profitable than most. It was about a 35% contribution business. So everything else has to fit into 15%. And you have to be awfully good to move that number meaningfully, even if you've gone to the best business school and the best manufacturing training in the world. And we thought we knew a lot about that. But at the end of the day, the business that I just sold for 7 times EBITDA did not have meaningful improvement in its manufacturing operation during the entire time I was there. We ran a lot more product through it, but basically the machine speeds and the way we did business were very, very similar. Something that was a tremendous source of pleasant surprise and robust earnings improvement was supplier synergy. In the case of our business, it was a pretty simple thing, as good ideas often are. And believe me, we chased a lot of bad ideas before coming to this one. But this one was just simply recognizing that the paper manufacturers' machines cost about $100 million a piece. Depends on the machine, maybe 50, maybe 75, but very expensive. The machines in our facility on the order of $2 million. Well, if for a moment you don't care who owns which machine should you optimize? Well, obviously the much more valuable one. But we don't own that machine. Well, as it happens, there was a tremendous opportunity to communicate more than our predecessor and most of the others in our industry had with our paper suppliers, and to find efficiencies in their manufacturing operation that were so rich and so tremendous that they dwarfed the inefficiencies that we willingly suffered as we bought paper from them. These were on the order of a 20% savings of paper costs. So remembering that paper is 50 cents of a sales dollar, if they're willing to share most of that gain, and in this case we're willing to share almost all of that gain because it made their process more efficient, you can drop 10 points to the bottom line. I mentioned there's some inherent inefficiency in our process, and that's true. We'd probably suffer a 2% inefficiency on that. 8 points to the bottom line in an industry that hasn't earned its cost of capital for 50 years, it's pretty good. And it was, without question, the single most sensitive knob on the machine. It also gave us the cost advantage that enabled us to grow the top line much faster than the rate of industry. We were the low-cost producers. We knew it. We picked battles that we knew we'd win, and we were able to grow. There was definitely a customer loss every year, but we were always able to more than overcome that. And again, this is an industry that hasn't kept pace with GDP during the 10 years that we were there. Now, with respect to the veteran Trammell Crow gentleman to my left, brokers were of absolutely no use to us before, during, or after the process. I'll narrow this to business brokers and the brokers of paper commodities. My experience is that if a business winds up with a business broker, there's a good chance that it's because the other obvious buyers weren't able to do the deal and didn't want to do the deal. We didn't find a single attractive opportunity through brokers, although we found that they were useful as trainers. You go in, kind of get your wrap down, and spend a little time doing what you were hired to do. So I started with a distaste for brokers before the deal. During the deal, it grew to a level of disgust because what I recognized was it's a broken business model. A broker has an adverse incentive with the two parties that he is charged with serving. If he can increase his spread, whether at the expense of the seller or the buyer, he's better off. Doesn't make them bad people, but it leads to bad behavior. And I wound up believing that selling my products through brokers was a mistake. And the couple of times that I made exceptions, I was burned. In the process of selling the company, not surprisingly, we weren't excited about selling through brokers, but as my partner and I contemplated selling the business in late 1998, early 1999, we wound up talking to a couple of brokers. And we may as well have taken an ad in USA Today, because in a matter of weeks, the entire industry, all of our customers and our employees knew that the business was for sale. It's not what we wanted to have happen. And even worse, we couldn't sell the business. The industry was in such sorry shape that even though each of the strategic buyers looked at ours and said, wow, those are fantastic earnings, they really couldn't understand how they were so good. And all they were confident of is that once they did the deal, they'd probably dumb down our results to the average of their plant, and they will have ended up overpaying. So one morning, we were dejectedly reflecting on the absence of quality offers, and my partner said, I would sell for half of X, and X was like a price that we thought was insulting. I said, I wouldn't sell for twice X. We looked at each other and said, well, at least we're going to do a deal. And as a matter of fact, we did. There were no buyers, but this was early 99. Money was cheap and easy. It's cheaper now, but less easy. And we thought, hey, maybe we can lever this thing up again. We were almost out of debt, and we can stop the clock on the equity and give the liquid return to the investors that we owed them for backing us from the beginning. Turned out that was possible. In fact, we dialed the price to the number that would give them a 31% IRR on the deal. And it turned out that a bank was willing to do that deal. It's pretty speculative. I was willing to do that deal because it gave me a controlling interest in the business. It was a great outcome for everyone else. The investors who wanted to sell, which were almost all of them, did so. The manager, my partner, who wanted to leave, did so. And the manager who wanted to stay, me, stayed, along with two elderly gentlemen who didn't know where they were going to put the money if they got it. So wound up just the three of us, single lender. Fast forward another 4 years. Manufacturing a commodity product just across the pond from China is not the best place to be, but we'd had a great run. Every year had been a record. What I needed was what I couldn't find 4 years before, somebody willing to buy that story. And frankly, that would be a hard thing to find, but for the fact that there was a terrific synergistic buyer on the East Coast with plants stretching to Texas, but no presence on the West Coast. But they were shipping a lot of product into California, and in turn, I was shipping a lot of product east. So if you manufacture the product where it ought to be manufactured, the freight falls to the bottom line. Looked like a good synergistic strategic deal, and we did that deal. In fact, we did it very quickly. It was one of those neat situations where I probably would have accepted less. I would have, and they would have paid more. So everybody's happy, and right now, I mentioned where I'm headed. The synergies turned out to be quite a bit richer than they expected and than I expected. My focus on buying paper was so intense that it turns out that even though they're $1.7 billion and we were a tiny fraction of that, I was buying a couple of grades of paper better than they were from the same suppliers. In the first 2 weeks, that threw off a $5 million recurring dividend to them in the form of their price falling to my price. Smiles all around. So they just informed me last Friday that they're going to release the escrow early and that they'll only need my services for a couple more weeks, even though I was supposed to work through January. So it's a great outcome, and I would certainly echo what I heard from the others. It sounds great now. There were some really dark moments, and some of those were even earlier this year as I watched China start to make inroads into the California marketplace. But I wouldn't trade it for anything. It was a thrill. It was exhilarating, and we're on to the next chapter.
Great story. Thanks, Brent. Joel?
Irv invited me to respond to these three and then to make some comments as an investor in search funds. And I guess I have to say that Josh was successful. He was a student of mine, and I turned him down when he invited me to invest. David's been successful. He was a student of mine. I turned him down. Brent here is successful. He wasn't a student of mine. I'm confident I would have turned him down. I have done about a dozen of these search funds, and they've been among the most successful deals that I've done as a private equity investor and among the worst deals that I've done. And I think the best outcome has been the one where the deal has really worked well. The second best outcome has been where the search funder has quit. Just said, I'm not going to do a deal. The worst outcome has been where the search funder has gone ahead and done a bad deal. And it takes a long time to work your way through a bad deal, and it's very painful not only for the investor, but for the search funder. I'm going to make a few sobering comments about the context, and then respond to some specifics. I used to say in the real estate business to my partners that you'll make all of your money once a decade, and find the confluence of events that come together that really make for a rich environment to do real estate deals. I think there's some similarities in the private equity and the buyout business, and I think it's a kind of a sobering time. Let me just give you a brief overview as to how we see the market. There are over 100 firms today with over $1 billion out there looking for deals, which means there's over $100 billion worth of uninvested equity. That most of them have portfolio company problems, which requires time, capital, and mind share on the part of the partners. They have unrecognized losses. A lot of them haven't marked to market, really. So these are future problems. And they're feeling fee pressures. Big funds do big deals. Big deals are competed for, therefore, very aggressively, which has driven some of these big funds into the smaller deals. So you start to see competition now as a search funder on these smaller deals. So the actual deal economics, in general, the overall context is that it's deteriorating. If you look at kind of a decade ago, we had record GDP growth and job formation, record productivity gains, low inflation, the cheapest and most available debt in history. Actually, not the cheapest, but the most available. Now is the cheapest that I've run across. A good IPO market with great exits via the NASDAQ or the NYSE. And you had lower equity requirements. When I first started doing this, it was 10 to 20% equity requirements. Now it's 30, 40, 50, 60% equity requirements. And the implications for less leverage are pretty impactful on returns. The problem that you always had with smaller market deals, which is what search funders typically find, of lower cash flows, poorer scale economies, less secure moats, were all sort of overcome by the fact that they were less well served by the capital. There weren't people pawing over all these deals. So these search funders would go out and they would find attractive alternatives in there, and that sort of overcame. With these larger funds now having a deterioration in their markets, you're starting to see them pick over. So I think it's a sobering environment to go out and do that. It's not to say that I still don't do investing in search funds, but I'm more cautious today. Now, to make a couple of specific comments about about what they said. In terms of raising capital, I would say one thing that we've learned is that money has faces with it, and I don't mean Franklin, Jefferson, and Lincoln. I mean who you invest with really matters. So who your equity backers are can really help make the deal, help raise the rest of the capital, get the company under contract, but then really, as young entrepreneurs, give you a lot of good advice. So you really want to select carefully who that is. Doing a search, we found that it's more effective when people, we've heard the sort of the lazy man's approach and the industry approach. Our experience with these dozen or so, and with a dozen or so we've turned down, is that those people who focused on industry have been more successful. They go to all the trade shows, they know all the people, and they find deals that aren't shopped, that never get shown to these larger funds. So those have tended to be more successful. In terms of negotiations, we have found that if we don't enjoy the negotiation with the search funder and putting the deal together, we figure that the seller, the buyer, other people aren't going to enjoy it either, and it's probably going to blow up at some point. And in terms of running the company, we have discovered that it is not a function of the success in running a company is not a function of brains or resume. There are some really fabulous resumes that come through. It's often a function of likability, trustworthiness, diligence, the stuff that you learned at your mother's knee, not at the GSB. Finally, the last comment. Do I have time to make one last?
Plenty of time.
I'm okay. Okay.
Keep talking.
All right. Here are the reasons that we've observed for failure. And this will seem like, business 101. But the first reason that these have tended to fail is because they're being in a bad industry, which means that it's an industry that's not growing. Growing industries tend to cover up a lot of errors on the part of search funders or more experienced business people. So really finding an industry that's growing is a real big plus. Quick example, the third private equity deal I did was buying a snack foods company where Frito-Lay had a 55% market share in an industry that wasn't growing. This business had been around for 40-some years. 18 months after I bought it, we took it into Chapter 11. So it just kind of shows that, do not get into the wrong industry. The second is ineffective management. And I think that's one of the challenges of search funders and one of the reasons to consider having a partner where two heads are really better than one. You can borrow each other's experience, bounce ideas off one another, because you can make a lot of rookie mistakes, and bad management mistakes can kill a good deal even in a good industry. There's this comment by Warren Buffett where he says, when he's a great management has met a bad industry, bet on the bad industry. I think that's generally true, but I would say in these smaller industries, we have found that great management teams are able to morph these small businesses into something else. So we've ended up saying great management teams will win. And the best example of that is this road rescue deal that is probably the best ever search fund result. I don't know, Irv would know.
I think so.
Yeah, probably is. I mean, this started out as a towing company down in Houston, Texas, and is now morphed into a specialty insurance company. And the great management team just morphed it from one opportunity to another. So in the smaller deals, I would say if you're looking at industry and management, I would bet on great management. The third reason that they fail is that the product or the service is really not compelling. There is not a real moat around it. The cost to produce the product or service is not significantly inferior to the value the customer perceives. And to try to think you're going to squeeze a little bit more out of it is really pretty tough. We think you have to have at least 15% EBITDA margins on there. And then finally, it's a poor deal structure. Paying too much, going in that old saw about well bought is half sold. If you can capture some value going in, it's going to be a whole lot easier. Your whole life will be a whole lot easier. Whereas if you have to create every dime of value as you go along, that's just one more hill to climb. Give yourself as many advantages as you can.
Forget roll-ups. Joel and I think this is safe to say, Joel and I have not seen a successful roll-up, meaning you're going to buy a series of small companies in the same industry and amalgamate them, assimilate them. It just does not seem to work. I think conceptually the reasons include that acquisition skills are not skills that most search fund entrepreneurs have, so if they have to keep drawing on those skills, it's difficult. They can buy one company that's larger and work with it. It's a whole lot better. It also includes the fact that search funders are not inherently good at assimilating companies. In fact, assimilating companies there are a lot of big company managers who are not good at that either. We have some right in our neighborhood who shall remain unnamed. It's a very, very hard job, and it's very easy to underestimate the cost and time of assimilating companies. Cisco is very good at that, has been in the past. And one of Cisco's approaches is the day of the closing, you, the acquired company, will take our chart of accounts and start using it, and you will start using our nomenclature. And they've just got the thing mechanized. Well, that's not very easy to do when you're a $6 million, $8 million, $10 million company. So roll-ups are contraindicated, to use a medical term, at least in my opinion. I'd be glad to open. Do the other panelists have any more comments before we open it up? Brent, David, or Josh?
I'd say one thing just with regard to to how difficult it is to agree with what Joel was saying. We were shocked, frankly, once we started going out there and looking at industries, at how much competition there was from private equity firms, whether because they were actually bidding on the company, or more frequently because we were looking at smaller stuff, there was a private equity-backed roll-up there. The characteristics that we liked in industries, which were growth, as Joel talked about, very important, profitability, very important, recurring revenues so you don't screw up the business too bad in your first 12 months. Those things are also the kinds of things that TA and Summit and Thomas H. Lee and all those guys with several $1 billion to put to work are looking for too. And the one thing I would say, I don't think there are any new industries under the sun. And for a search fund to be successful, what that means is you kind of got to look in the places that they're not interested in, and yet you can't compromise on those fundamentals. And the only places that you're left with then are tiny, tiny little niches around some of these large industries that do have those fundamentals. And I think that that's really, really hard to do. And the one thing that my partner and I both believe is we're very happy where we are. We bought a business we're very comfortable with. It's growing. It's profitable. It's all going very well. But I don't think we'd do a search fund if we were doing it again. And so I would disagree. I know Josh probably would. We probably wouldn't. Not that if we knew we were going to finish off where we are now, we would. But we think that we just got real lucky. And we think that the odds on finishing off where we are really pretty darn small. And that the chance of doing something otherwise, which is the worst type, as Joel said, which is you buy the wrong business, is actually pretty high. And the temptations are very high when you're out there trying to buy. And so we're pretty contra search funds right now. We're telling everyone who talks to us that we think that we want to think about it very hard before getting into it.
Yeah, I'll just echo that quickly. John and I thought you were going to fail as well. So we did fun together. So good job.
Well, I'll make one comment in that regard. If you've done a successful search fund, you're on a list here, you're on a list at Harvard, and I'm probably averaging a call a week from a prospective search funder, many of whom do in fact go on to raise a fund and move forward. So I would guess, you could confirm this, that there are probably more active search funds now than there have ever been. In the same way that a couple will sometimes have two children to sort of cosmically replace themselves on the planet, I've invested in one search fund, and I think I'm going to stop there. I did that about a week after my deal closed with a young Harvard grad who I think is going to be successful. But I would certainly agree that the competition is getting tougher right now, and you've really got to have a thirst for this to want to jump in.
You had mentioned that you purchased a company in industry that was growing at less than GDP and had returns on capital less than weighted average cost of capital. And can you talk a little bit more about your investment thesis and why you were so excited to get in this industry?
Yeah, to be totally candid, I mean, we weren't that excited to get into this industry. We were 2.5 years in, absolute white knuckle stage. We had raised a second round, burned through that, hadn't paid ourselves a salary in about 4 months. And it would be fair to have questioned our objectivity about that deal at that time. As it happens, necessity is the mother of invention. Once we were in, I mean, I'd say the first year we sort of pushed money around. We didn't generate a lot of cash flow. We were not happy. We were working long hours, and we were scared that we'd made a mistake. As the years wore on, our results improved, but were dwarfed by the returns from our pals who did .coms. And we were feeling a little foolish to be out in Fresno making boxes when they're making hundreds of millions. That said, you fast forward a few more years and it doesn't look as dumb. But we didn't make hundreds of millions either. But we did generate terrific returns for our investors. And I touched on the most robust source, which was the synergy with suppliers. And I will say that if it weren't for that one that we didn't foresee, I don't think we would have had great returns. I mean, and I would echo what Professor Grossbeck said. I don't think this was a template that we could have laid over other similar businesses. We had a proximity to a couple of suppliers who really listened to this idea and were able to make it go. It's also the case, and I will say this about an industry like the one I'm leaving, it doesn't attract the best and brightest. And you wind up with competitors that, really sort of type like this and, they're not that good. So, I mean, I found them making mistakes.
Do they move their lips when they read?
Yeah.
Well, I do that too. But seriously, in some of the sleepier industries, you can find people asleep at the switch, and you can take share from them, and you can have insights that they don't have. The very final point is there's a company doing the same revenue as mine in the same industry, serving the same customer set in Los Angeles. That's 220 miles from where my business was in Fresno. We just hired their COO, and they're losing about $300,000 a month. They have 4 unions. It's a 4th-generation family-run business. They're idiots. I mean, they're really not good business people. You can't take that for granted, and we certainly have some smart competitors, but it can be an advantage to be in a sleepy industry that other people neglect.
Do you guys consider exit upon entry into an investment, or are you happy just sticking to a business that generates a lot of free cash flow and dispersing that to your investors such as they're achieving attractive returns?
Well, I'll make a comment on that because we morphed from a model that we thought we would flip the company in 5 years to one where, since we didn't have that option, we needed to start paying dividends to generate a return and, again, to try to stop the clock on the equity. Your choice of legal entity, legal form is pretty important if that's a probable outcome for your deal. I mean, in this case, it led to my being able to repurchase the equity and to gain control. But in the meanwhile, being an S corp or any pass-through entity, LLC or partnership, you didn't have a second hit on that dividend distribution. So we were, in fact, able to distribute quite a bit of capital along the way.
Question for Joshua and David about your day jobs prior to launching this process. Did you start the process while you're at your day jobs? Did it matter what you were doing beforehand? Did you handle that transition?
I had a great situation because John had already left his job. I was still working, so we said, this is our partnership, 50-50 all the way. And John, you go work on this, and when we get up and running, I'll join. But I tried to do a little bit of that for a very short period of time. I tried to just kind of do it on nights and weekends and talking with John offline about things he was learning. But to be honest, as soon as we made the decision that we were actually going to formally attempt to raise the fund, I quit my job that day. And I don't know how we would have done it any other way. I think a lot of people like to hold on to that, and I talk to a lot of aspiring search funders who say they're going to keep doing what they're doing until they've raised the fund. And I think you could do it, but it's just amazing how much effort it can take to successfully raise the fund.
Yeah, I'd echo that. I mean, part of it is I was working at McKinsey, and so there weren't any nights or weekends free to actually spend on the search fund process. But I do think that you need to dedicate yourself to it. I mean, not least just from an emotional point of view for the partnership, you need to both be leaving stuff behind and jumping into this thing, because if you're not prepared to make those kind of commitments to get to raise the fund in the first place, then you're going to have real problems as you start hitting bumps through the process, I'd suggest.
Well, investors will see that right away, too. Investors can see right through you to your commitment, and it's absolutely crystal clear to them. So if you haven't burned the boats, it's unlikely you're going to raise the search fund.
Because you decided to be a search funder, but at that time you said you believe you will get the money, and you believe you will be a good manager. So why didn't you just set up your own company instead of being a search funder?
Why not start a company?
Yeah. From our perspective, we did think we'd have a great chance at running a company well together. We did think we had the skills and the connections to raise money. But there were a number of the risks that you mitigate through going the search fund route, or even absent the search fund, acquiring an established business. And for us, that was a big part of it, was that we felt like there's a lot of risks in actually starting up an organization. We preferred to buy something that was already throwing off a healthy amount of cash, had built up a stable organization. We knew a little bit more about what we were getting. The other big element for us for raising the search fund, and I mentioned this in my initial remarks, was that it was the opportunity for us to go out to a group of investors that we thought would be great mentors for us. It's really a unique opportunity to hand select a group. One of them sitting in the back right there. Whether or not he's enjoyed the experience or not is up in the air. But it really does help to have people to lean on when you're doing it.
Eldon?
How do you guys limit exposure to past liabilities, things that you didn't know about when going into to do your due diligence on the company? And what's your perspective on a asset sale versus purchasing equity?
We did an asset sale to minimize as much as we could the liabilities, and then we had an escrow account for which all of the things we thought could go wrong, there were claims laid out against those. And we spent an inordinate amount of time doing due diligence nonetheless, because frankly, even if you can claim and you can get the cash back, you're still in terrible trouble if you're having to claim and you're in a bad situation. And I think we were overly cautious in terms of our diligence, and I'm kind of glad that we were. It's kind of type 1, type 2 errors. I think you're better off being far more diligent and cautious in your due diligence and potentially losing a deal as a result than you are taking the risk that potentially the thing blows up on the other end.
Yeah, I'd really echo that. Every buyer wants to buy assets, every seller wants to sell stock. I bought assets and I sold stock, but it isn't because I was the buyer of my company was missing something. The fact is, the people in this room with this skill set, you're likely not to make a lot of the mistakes that somebody might have made 30 or 40 years ago, and you're likely not to create the skeletons in your closet, whether it's sexual harassment, environmental contamination, whatever the things might be that relate to your industry. And indeed, you're likely to have audited financials and to run a really clean shop. The buyer of my company could see all of those things. They jumped right out at them. The books were clear. They were audited. There was no environmental problems. We had an up-to-date employee manual. All of those things gave them great enough confidence that they were able to buy stock. And in this case, there was a tax reason to do so, which helped both the seller and the buyer.
Just a quick footnote and then some more questions. It's easy to think a search fund is too risky, and you've heard some advice that says now's not a great time to do it. I probably wouldn't do it again. You've heard some other advice that says, boy, there are a lot of well-funded, larger entities out there with whom you'll have to compete. And so I don't think I'm going to do a search fund, and that's more than reasonable. I think I'll go to work for somebody. I would just like to underscore, or I'd just like to tell you that I've been teaching for over 20 years, and I've seen a lot of former students come back and tell tales of what they're doing. And there are literally tens of students who said, you can count on it, I'm going to have my own company. And they got out there, and the window of opportunity is, and this is a really risky statement, but the window of opportunity is something like up to your mid-30s or so. It's a fairly small window of opportunity because very gradually and subtly your risk profile changes as you build in patterns to your life when you're employed, and perhaps you have relationships that develop, and maybe you have a family and you get settled and you have institutional relationships. You go and work out at a certain time of day, and very, very subtly your risk profile changes, and literally tens of those students who were absolutely determined to have their own company are now employed and likely will be employed in days to come. So there's no risk-free course. We're just examining the pros and cons of this particular one. I think it's suitable at the same time to think about the risks of not doing a search fund.
Even presuming the financial success that comes with your efforts and putting yourself in a situation, or for us as onlookers, putting ourselves in a situation where we achieve success, the question remains, what happens next? I mean, what happens after you have the success? What type of a position have you put yourself in from a long-term career path? And to highlight that, I mean, I think all of you have emphasized the extent to which luck has played a very important factor in your success. And as someone who's had some experience in private equity, I can relate to that. I think that deals and great returns don't really happen without luck. Except that in the private equity world, what you get is a group of investors who say it wasn't luck. It was our ability to create a culture, create a great shop, deal source, have, instead of one industry, invest in 5 industry and gain expertise in all of them. In your particular situations, you've each locked yourself in a way, you could say, arguing as a devil's advocate, to one particular industry. You have operational experience, but you only spent X% of your time actually searching for deals. Most of your time is operational, and the likelihood of you investing again in the same industry is probably very small. So there could be a nice devil's advocate argument for your ability to replicate your success. And so how do you consider your position after you've achieved your first success?
Well, I think if you're lucky enough, you're not that worried about your career path. And I also would say that the search fund process proves that your skills are transferable. We wound up in an industry that was 20th on our list. It wasn't even on our list because we burned through a bunch of other industries. But we're still able to find a way to be successful. And I think what you learn here, I've heard the metaphor, I heard it from my partner first, that the GSB, this kind of preparation, teaches you how to fly the plane, but it doesn't necessarily teach you how to take off and land. So it's certainly the case that you're not necessarily a good deal doer, but you're probably going to be a good operator, especially if you really have to be because you've burned the boats. So I walk away from this experience very confident that I can move into a completely unrelated industry, and confident that the investors who backed me in this one would back me in that one.
And actually, if you build up some capital, the range of career alternatives includes non-business activities, pro bono activities, a whole range of things. Go write the great American novel. There are not a lot of employed people I know in mid-career, no matter how successful they are, who are emotionally ready to leave and go do something dramatically different. They may or may not be financially ready. It's hard to amass capital through savings out of income. You may amass it through stock options and be fortuitous that way as an employee, or be fortunate that way as an employee. But then you have the whole psychological element of, am I ready to kind of leave this place that's been so good to me? Maybe I should just stay a little bit longer. It's hard to leave. And I think if you've gone off and done something on your own, that you have a different psychological profile and a readiness to try new things. I know several entrepreneurs who are as far away from business as they can get, and they're doing all kinds of interesting things. One is right here, about to go to New Zealand, and he's not sure what he's going to do later, and frankly, he's not too worried about it.
Given that particular risk profile that you were talking about earlier is fairly young, fairly at an early point in your career, how did you know that you were ready and capable of going off to run a company? And secondly, once you got there, how did you establish yourself within that company as a capable leader, being so young?
Are we that young?
Well, I look like I'm about 14, so I guess I'll answer that question. During our search, we had a group sit across the boardroom table from us and note that we were about as old as his daughters, and what business did we have running his business? And that's a feeling that it was hard to rebut that, really. But the truth is, it requires a lot of self-confidence. It requires a lot of risk-seeking. It requires a willingness to believe that what you've learned up to your career to this point can really be put to use on your own. And it is a scary leap of faith, there's no question. But one of the nice attributes of the search fund is you're not doing it alone. You do have a seasoned group that you can pick up the phone and say, hey, tomorrow's the big meeting. Tomorrow's the day we go in and we announce to the employees that we are now running the show. How would you advise we do this? And you can get some people that have gone through that very thing before to counsel you on your tone and the way that you do it. And John and I think have been pretty fortunate. We spend a lot of time talking about decisions that we need to make, about how we're interacting with the employees, and we talk to our investors, and it's working out really well right now. I think anyone in this room could do it.
I remember when I was here, I had lunch with Irv once, and he said that on a scale of 1 to 10, raising the fund is like a 3 out of 10. Buying the company successfully, in terms of difficulty, is an 8 out of 10, and then running the business is a 5 out of 10, which in fact, in retrospect, I think is pretty much bang on, actually. And it's not that tough, particularly to Josh's point, if you have a seasoned set of advisors, and it's a pretty tight-knit group, the search fund folks. In the last 10 days, I've spent probably 4 hours total on the phone talking with some of the road rescue guys, talking with the MedMart guys. We talk every now and then. So when we've got a set of issues that we're not prepared to deal with because we're too young or we're inexperienced, we got a whole bunch of folks we can talk to, and they help us out in those things. The other thing I would just say is I think what we've tried to do, and I don't know how successful we're going to be because we're only there for 10 months at this stage, but what we did try and do was not to change too much at the start and come swaggering in and say it's going to be our way or the highway from now on. Rather, we kind of sat back and watched a lot, and we listened a lot, and it was a pretty successful business when we bought it, and we kind of gave a lot of credibility to the people who were there. Our first quarter, we were pretty much just listening. Our second quarter, we were asking a lot of relatively pointed questions. This third quarter just passed is the first time we've really started pulling a little bit on the levers, and we still trust our employees a lot, and that's kind of important too. You don't just jump in and start changing things around, I think, or at least we certainly haven't done that. And that was advice that we received that I think has been good.
Thank you for a very informative panel, panelists. Thank you.